Hello, in this video I am going to cover the difference between principal and interest on a mortgage. So principal is basically the money that you borrow. That's the money you have to obviously pay back. The interest part of it is the extra amount that you pay back. You can consider it a fee for the bank, or could potentially be a non-bank organization, but usually some sort of bank organization for lending you that money. So if you have a principal of £100,000, so let's say you borrow 100,000, and let's say the property itself costs 120,000. So that means you put a deposit. Let me undo that. Deposit of 20,000. That, obviously will get you a certain percentage. It's just a tad under 20%, and that means you are borrowing £100,000. And let's say if the mortgage is 30 years, that means at the end of the mortgage you need to have paid back the £100,000, but the bank generally will want some sort of interest. So let's say the interest on this mortgage is a total of £50,000, so you will pay back a total of £150,000. Okay, so let me open up a graph. I'll paste it here. So I already, no, I don't want to do that. Here we go. So if I put this over here, scroll down, make this a little bit bigger so you can see everything that's going on in here. So I've got this graph off Google. You can find a bunch of other ones. So it's a 30-year mortgage. And let me use a different color, something a bit that'll show. So it's a 30-year mortgage. It's for a $200,000 loan, and the interest and principal components by year are here. So they're paying $15,000 per month. But what's really interesting is this part here. So you got the principal and then you got the interest. If you look in year one, the majority of the $15,000 payment, so $13,000 of that $15,000 is interest, and only about 2,000. I'll use a different color for that. And only $2,000 roughly is the principal. Then a bit more is principal, then a bit more, then a bit more, and all the way when you get to here, the majority of it is principal. And after year 30, assuming you've done, no late payments, so you've incurred no fees, you've been paying on time, you will have paid it off, and you will have not paid any extra beyond the principal and the interest. So why is the principal so little at the start and the interest so great at the start? There's two reasons. One, the interest is a percentage of what you owe to the bank, and as you pay more principal off, so as you basically go from here to here, as you pay more principal off, there's less interest on your total amount that you've got left to pay. That's one reason. The other reason that it's actually structured like this, it helps de-risk it for the bankers. The bank wants to make money. The bank is just an organization that is doing a business transaction. So they're thinking, if we can get more interest initially, and if, let's say, worst case, after 15 years, most people would probably be on the assumption that after the 15-year mark, so halfway, you paid off half of your mortgage. And though you paid off half of the mortgage, but not half of the principal of the house. So if for some reason you can no longer sell your house, the bank, you can no longer pay, but you can sell your house, you're not going to get 50% of that because you think, I've paid off 50% of the principal. Nah, you've barely paid, I don't know what the exact percentage will be, probably 20-30% max of the principal. So that means the bank gets a greater sum of that. So that helps de-risk it for them in case you do not pay. That means they can have more of the money. as well. So that's another reason. The other thing is, so on this mortgage, $15,000 a year, could be pounds, doesn't matter, times by, what is it, 30 years, times by 30, so that is $450. $450? 450. Sorry, those are yearly payments. Yeah, that's right. $450,000. So as you can see, you are paying more than twice as much for this property compared to if you had cash. Obviously, most people won't be in a situation where they got like $200,000 lying around to buy it, so therefore they have to access a mortgage. Therefore, they'll have to go through this process of paying more principal, more interest initially, less principal at the start, and as time goes by, more and more principal will be paid and less of it will be interest. Each month you're still paying the same amount, it's just more of it is going towards principal, less of it is going towards interest. So that's the reason when I see people within the first, I'll say 20 to 30% of your mortgage term, that's the length of the mortgage, selling their property to get another one, and they're not in some crazy amazing financial situation, I'm like, it's kind of silly, because you actually haven't paid that much of the mortgage off. You've paid a lot of money, but not much of the principal off. So that's just something to bear in mind. I've seen people do it, I've seen family do it. It's just stupid that they would do stuff like that. But people get bored of houses and like they get bored of everything else, and then they choose to spend more money, try and get a nicer house, and they'll end up getting bored of that after 5-10 years, then get another property. So that's the difference between principal and interest. Remember, principal is the money that you borrowed and that you have to pay back. Interest is the money that you are paying back as basically a fee on top of that principal. If you have any questions, feel free to pop me a message, and as usual, I look forward to seeing you in the next video.